All right, let's strap on our analytical gear and dive straight into one of the absolute most fascinating valuation puzzles in the market right now. We're looking at AnaptysBio, trading under the ticker ANAB. In this explainer, we are going to act as expert investment analysts. We're taking all the raw data and pushing this company through a gauntlet, the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some heavy-duty discounted cash flow modeling. Let's see how it holds up.
Here's the game plan. We'll start with a company snapshot, move into the Buffett and Graham lenses, explore the Peter Lynch lens, run a DCF valuation model, look at alternative valuation models, and wrap up with our synthesis and final call.
Starting right off with Section 1, our company snapshot. Let's get a baseline reality check.
$57.51. That is the current share price of ANAB, giving it a market cap of roughly $1.67 billion as of mid-2026. Keep this $57 figure locked in your head because it is going to be our ultimate anchor as we test whether the market is drastically mispricing this stock.
Now, what's absolutely wild about their current position is the massive friction in their metrics. Looking at the Q1 2026 data, they are sitting on a massive cash pile of $286.5 million. But right alongside that, they're operating at a steep net loss of $52.9 million, leaving us with a negative earnings per share of $1.84 for the quarter. To any casual screener, negative EPS is a giant glaring red flag. But, in the biotech world, context is literally everything.
And that brings us to the turnaround story. Back in April 2026, Anaptys finalized the spin-off of First Tracks Bio. They effectively shed their expensive cash-burning R&D operations. So what's left? An incredibly lean royalty collection machine. They operate with a minimal staff and are targeting an EBIT margin of greater than 95%. They've basically set up a toll bridge, just collecting cash on GlaxoSmithKline's blockbuster cancer drug Jemperli and Vanda's imsidolimab.
Moving into Section 2, let's run this new, lean machine through our historical lenses, Buffett and Graham.
If we start with Benjamin Graham's defensive checklist, ANIO mathematically fails the traditional backwards-looking screens. Graham demands earnings stability, which we don't have with a negative EPS, and he wants a moderate price-to-book ratio. With a tiny stockholders' equity of just $12.7 million and a history of retained deficits, their PB is astronomical. It does, however, pass his test for strong financial condition simply because of that nearly $300 million cash stockpile.
The crucial point here is that Graham's famous formula physically breaks when you try to apply it. If you plug that negative 1.84 EPS into the equation, your calculator literally spits out an error. You just can't calculate the square root using negative inputs. Graham's strict quantitative rules were built for railroads and industrials, not a biotech firm transforming into a royalty company. So for Graham, this stock goes straight into the too hard pile.
But where Graham would walk away, Warren Buffett might actually see a massive economic moat forming. Buffett loves predictability, high return on equity, and honest management. With the spin-off complete, Anaptys doesn't fund the R&D, GSK does. They don't fund commercialization, GSK does. Their owner earnings, which we know is Buffett's absolute favorite metric, are poised to explode because capital expenditures are essentially zero. With those 95% margins, Buffett would likely scoop this up with a margin of safety anywhere under $70 a share.
Let's shift gears to Section 3, applying the Peter Lynch lens. Lynch famously loved to categorize companies to really understand their narrative. So where exactly does a transitioning biotech fit in his 6 categories? For sure, ANAB is a classic Lynch turnaround mixed with an asset play. The broader market is still pricing it like a cash-burning biotech, completely ignoring the hidden asset underneath, that pure-play royalty stream. Now, calculating a PEG ratio right now is tricky because of the negative earnings, but forward EPS is actually projected by analysts to hit $5.24 in 2027. When that turnaround completes, the implied growth rate is huge, making the forward PEG incredibly attractive. When you look at Lynch's checklist, you see 44% royalty growth for Jemperli and a massive $100 million stock repurchase plan. Lynch always hunted for insider confidence, and dedicating $100 million to buybacks on a $1.6 billion company is a giant signal that management knows these underlying assets are cheap. Add in a rock-solid balance sheet and relatively low institutional hype, mostly because traditional screeners are terrified of the backward-looking net losses, and this is exactly the kind of misunderstood story Lynch would aggressively buy.
All right, moving to Section 4, our discounted cash flow valuation model. Let's do some forward-looking math.
Because those historical models fail, we have to explicitly project forward free cash flows. Here are the assumptions we're plugging in. Management is guiding for over $390 million in peak Jemperli royalties by 2029. We apply that incredible 95% margin since operating expenses are basically gone, which gives us roughly $370 million in free cash flow at peak. Then, we'll discount that back using a conservative weighted average cost of capital, or WACC, of 10%, alongside a perpetual terminal growth rate of just 2%.
Discounting those massive future cash flows back to today gives us an approximate fair value of $103 per share. Think back to our anchor. The stock is currently sitting at around $57. Our base case DCF suggests we are looking at a near 45% discount to its intrinsic value. That is a massive margin of safety.
And even if we want to play it extremely safe, the numbers still look great. If we bump our discount rate all the way up to 12% with only 1% terminal growth, the fair value still sits around $85. On the flip side, if things go perfectly and we use an 8% WACC, it shoots up to $130. In almost every realistic scenario we map out, the current price is a severe undervaluation of the future cash flows.
Let's bring in some other perspectives in Section 5, Alternative Valuation Models.
A sum-of-the-parts model isolates everything nicely like a puzzle. They have $286.5 million in cash. With roughly 29 million shares outstanding, that's nearly $10 a share just in pure cash. Then you layer on the net present value of the Jemperli royalties. Next, you add the upcoming December 2026 FDA action date for imsidolimab, which adds a whole new royalty layer. Yes, you do have to subtract the roughly $325 million in non-recourse debt they owe to Sagard, but remember, non-recourse means it's secured only by specific royalties, protecting the rest of the business. When you add all these distinct parts up, the total easily eclipses the current market cap.
And Wall Street consensus actually backs up our math. Out of 11 analysts tracked by S&P Global, the average price target is $87, with a high target reaching $140 per share. The overall consensus is a strong buy. So we aren't out on a limb here at all with our DCF. The broader analyst community sees the exact same mispricing we do.
Finally, Section 6. Let's synthesize all of this and make our final call. Blending all our insights together, Graham is fundamentally out because the negative EPS breaks his model. But Buffett sees a pristine 95% margin Tollbridge moat and would buy under 70. Lynch sees a wildly misunderstood turnaround backed by a $100 million buyback. Our DCF models out a fair value of $103, and the street average sits firmly at $87.
Therefore, our final explainer recommendation is a very solid buy. We acknowledge that the massive potential of this royalty moat far outweighs the risks. Now, to be totally objective, you have to keep the risks in mind. They do have that $325 million in non-recourse debt, even though they plan to pay it down by 2027. More importantly, their current valuation heavily relies on one single asset, Jemperli. If GSK fumbles the commercial execution, AnaptysBio takes a hit. But, considering GSK recently reported over 40% year-over-year sales growth for the drug, the momentum is undeniably in their favor.
The math heavily supports the narrative, but ultimately, you have to decide if you believe in the future cash flows of this transitioning royalty machine. The real beauty of this explainer is how perfectly it demonstrates why blindly relying on traditional screeners, like historical EPS, can cause you to miss out on incredible opportunities. AnaptysBio is a textbook turnaround, shedding heavy capital costs to become a pure cash-flowing asset play. Definitely keep an eye on those forward earnings and upcoming FDA dates. Thanks for joining me on this valuation stress test, and I will catch you in the next explainer.